Okay, I just realized this paper still have one questions, but never mind, just now too tired already. Okay, these questions you need to discuss 3 reasons why in case where IRB does not hold, covered interest arbitrage might not necessarily take place. 6 marks. So 3 reasons you need to explain why CIA might not happen, might not occur. So this is quite straightforward. Okay, you cannot create your own answer. This one, this one transaction cost. Due to transaction cost, you can refer to the lecture notes. Same, because the transaction, when we calculate the covered interest arbitrage, we didn't. We assume that transaction cost is 0. We haven't taken into account yet. And you realize that when we perform the arbitrage strategy, the amount that we invest is actually very large. If let's say large amount like 1 million, 2 million, you only earn, let's say, few hundreds. This is too small. Okay, after we minus the transaction cost, maybe we left nothing. Okay, that's why CIA may not able to occur. The second one, due to political risk. Okay, we can foresee there is an opportunity to invest in other country. However, due to the government restrictions, maybe currency not able to convert, cash flow restricted, and so on. So all this will be, so that it will cause the CIA does not occur. And the last one is the tax policy. Since only 6 marks, so one, if you mention transaction cost, 1 mark, elaboration must complete 1 mark, 2 marks. Okay, so for this past year question, just only focus on the question that I discussed today. Now we move on to another set of paper. October 2023. Okay, so let's look at first question. Another case study. First question definitely is a case study. Okay, this is a Malaysian company. Manufacturer that source raw material from Taiwan and sell its product in Malaysia. Okay, all raw materials purchased are paid in Taiwan dollar. So they import from Taiwan and then they sell it in Malaysia. So they invoice in Malaysia ringgit means they receive in ringgit Malaysia. Okay, pay Taiwan dollar, receive Malaysia ringgit. Okay, previously the company had no intentions of hedging its foreign currency exposure. However, after consultant, now they need to do hedging. Okay, the current spot value is 0.04 per Taiwan dollar. So the base rate is in front. Okay, this is 1 unit. And then Aloha Berhad is expecting to purchase 5 million Taiwan dollar worth of raw material in 3 months. Okay, purchase. So this is payable, right? Okay. But this question is not about money market. It's about range forward hedge and currency option hedge. This question I use it to discuss because I want you to focus more on currency option. Okay, but since proposal 1 range forwards is here, we covered together. Okay, so you are going to consider these 2 hedging strategy. Range forwards means currency rate. Same terms. We have 9 methods to hedge the transaction exposure. One of them called currency range. So currency range is range forward, same meaning. Here got mentioned, currency collar. Okay, so the company can purchase 3-month currency collar contract for Taiwan's dollar with band from 0.04 to 0.045. It will give you a range one. Okay, the concept of the currency collar is if any future spot rate fall below 0.04, all will be paid by 0.04. If fall more than 0.045, then all currency conversion will be using the upper bound here. Okay, the only not covered is the between one, 0.04 until 0.045. If you fall, let's say 0.041, then you will pay with 41, not 40, not 45. Clear? Okay, currency options, they give you what? Can purchase 3 months call option. Okay, why call? Because purchase. If you sell, then definitely it will be put one. Okay, this one you have to practice because now you give it. Maybe the question will ask you need to purchase call or put. So you need to determine if you want to pay. Okay, if you want to pay, go for call because you want to lock at the lower rate. If you want to sell, receive money, you're going to use put. You lock at the higher rate. This is a strategy as an option holder. Okay, the strike price K is given. It's set at this price. Premium is 0.05. So I use C to determine call premium. Okay. Part A. Explain the BOD, how the appreciations of Taiwan dollar may impact the company raw material cost if without hedging. 4 marks. This one is bonus, meaning that you need to elaborate any justifications that can cause company loss or company being exposed to the risk if they didn't do any hedging. If they do nothing means uncovered. What happened? What if the Taiwan dollar appreciate or depreciate? You want to pay, right? Pay what? Pay Taiwan dollar. What you worry? Taiwan dollar appreciate. Then only you pay more, right? So you have to describe this part. Start from when currency appreciate. When Taiwan dollar appreciate. So here 4 marks, right? You can explain any relevant 4 answer here. Without hedging, company is exposing to currency risk due to currency fluctuation. Then elaborate. The cost of the raw material price in Taiwan dollar would increase when converted into MYR. Or you can say that when Taiwan dollar appreciate, here already mentions, right? Okay, it will cause the import cost increase. So the company will have to pay more to purchase the same amount of raw material from Taiwan. The volume that you purchase is the same, but now the cost is higher, so it may lead to what? Lower profit. Lower profit. Try to study the structure of the answer, how they organize the answer when it award you 4 marks or different mark allocations. Okay, taken Move on. Okay, assumes that spot rate 3 months from now means that this is S3. Okay, S3. Determine the amount of ringgit that Aloha Berhad will pay at the end of 3 months if the company hedge 5 million payable with number 1, range forward. Okay, now the S3 is 0.048. Just now look at the range given just now. 0.04, 0.045, right? Okay, is fall under lower or upper bound? 48 is upper bound, right? Correct. 48. Upper bound. So how much they need to pay? They need to convert using 48 or 45. 45, yeah? Okay, because it's already locked into agreement. If more than the upper bound, all will pay by the upper bound rate, which is 45, not 48. So quite easy, this one. Okay, just multiply only to get the answer. So for part 2, What if you use hedging, option hedge? Okay, look at here. I write again on the whiteboard here. The blue color one is when the question asks you how much is the profit, okay, using call or put. This is the formula for profit. The black ink one is how much you need to pay or receive using the options. Different questions like this question is said how much the company will pay, not profit. So you cannot use the blue color one to calculate. Okay, as an option holder, either call or put, you still need to pay for the premium, the call premium and the put premium. Okay, so payments you need to pay. That's why this is plus C, call premium. And because this K is the price that you agree to pay if you exercise the call options. Yeah, you enter into the call options, you agree to pay using the K price, right? So when the question asks you how much you need to pay, K plus C. K is the agreed price, C is the cost that you need to bear. So K plus C. Okay? So the formula is K plus C times the quantity. For this case, is 5 millions. So you just substitute in to get the answer. Okay, I tell you what, this is very easy questions, but most of your senior actually not able to score because most of them go for this formula, misunderstand what the question want. But if the question give you spot price, like this part B, they give you spot price already, okay, and then ask you how much can the company earn profit, then you use SD minus K minus C. Okay. Here is call option. I also give you the put option. Why K minus B? Because this is the amount that you need to pay minus the total amount that you receive because you sell product, you sell using the K. So after you receive, okay, when you enter into the contract, you need to pay first, pay this premium. End of the maturity date, you sell at K. So this amount that you receive. Net receivable is K minus B times Q. Okay? By understanding, you can actually remember when to minus, when to add. Because this is payment. You pay. You pay. That's why you add up, sum up. Okay? Copy down. Okay, so this question is about range forward and option hedge, right? I think next part definitely it will ask you to provide recommendations, yeah? So which one, because this is payable, we choose the lowest one, yeah? The lowest one is range forward. So answer is range forward, why? Because lower than option hedge by how much? By 10,000. 3 marks. You recommend. Reason why? Because less. Pay less. Then pay less by how much? 10,000. You can write in one sentence to get 3 marks, as long as this 3 is in your answer. I'm just thinking that combining of this, just now the set 1 past year questions, 2024, we learn forwards, right? We learn money market, and this one option, correct now. These 3 may ask you to calculate, and then later on you compare these 3 possible, yeah? Okay. Done? Okay. Part D. We go to the part D straight. This is C. Let me see. Okay, this is C. This is D. Part D, question 2. Skip the question 1. The company can use exposure netting to hedge against currency risk when exporting to Taiwan, where the company import raw materials. Okay, 3 marks. So what is the complete questions? I forgot to copy. Forgot to copy this part. That's why. Okay, this is due to declining sales in its home market. Company is planning to export its product to Taiwan to supplement its revenue and expand its market reach. Then the company can use exposure netting to hedge against currency risk. So no calculation, just to compare. You need to explain how they use it to export to Taiwan. Just now, they import from Taiwan. At the same time, now they want to export. So remember, exposure netting will occur when we have cash inflow and outflow using the same foreign currency. So we are not going to hedge both total cash flow, but we're going to hedge the net cash flow. Okay, so here, since we don't have the amount of figure, you need to describe using your own way. So let's look at the sample answer here. Okay, netting, this is answer from the tutorial. Not tutorial. The last tutorial, yeah. Netting the amount is a way of reducing amount of cash flow within the organization. And then a method of hedging currency risk of offsetting exposure in one currency with exposure in the same or another currency. Those who under my tutorial class, you have heard this before, right? Okay, if you already attend my tutorial 11. Those who are not, let me explain again. Take this as a revision. Netting exposure means that assumes this is now this is a Malaysia company, right? And then initially they import from what country is that? Taiwan. Okay, import. Then now they want to export at the same time. Export means receive money, right? Taiwan dollar. And pay, they need to import, then we have to pay Taiwan dollar. So inflow and outflow at the same time. So here, why they say reducing amount of cash flow? Assuming here export, the amount is Taiwan dollar 1 million. This one is 5 million. According to the questions, let's say 5 million. Okay, when we say we want to pay 5 million after one certain periods, right? Same period, let's say 1 year. Then at the same time, export 1 million. So this 1 million, you don't need to hedge, because you can take it actually offset. You can take this 1 million to offset here, to offset 1 million here. So we left what? 4 millions to hedge. Instead of 5 plus 1, 6 million total cash flow, because the higher the amount that you need to hedge, the higher the cost of hedging you need to pay. So here the first point is said is a way to reduce the amount of cash flow. Okay, so cash flows within the organizations instead of 6 now become 4 only. Okay, so we are not going to enter into 2 contracts. Hedge the receivable, hedge the payable. So this will be costly. So they try to use the method of offsetting the exposure. Okay, so we are going to hedge what? Payable 4 millions only. If payable, let's say using forward contract, how to hedge? For payable, we want to pay, right? Lock at the lower rate, we buy forward. If it's receivable, we sell forward. Not asked in these questions, but for your understanding, just in case the question asks you to hedge. Okay, so not yet finished, because 3 marks. Here you need to describe. Exposure netting involves calculating the net exposure by offsetting the Taiwan dollar inflow from export with Taiwan dollar outflow from imports. So we are comparing whichever is higher, we hedge that one. Like this case, payable is higher, we hedge payable. If receivable higher than payable, then we hedge receivable. Okay, if the value of export in Taiwanese dollar exceed the value of import in Taiwan's dollar, there will be net inflow of Taiwanese dollar. they just put what I said just now in words. So you need to describe like this. Conversely, if value of import is greater, then will be net outflow of the Taiwanese dollar. So you can use your own words to explain as long as whichever is higher, payable more than receivable, H payable. Receivable more than payable, H receivable. H payable. What I say, I forgot already. Okay, H whatever is higher amount lah, huh? Okay, can understand lah? So for this coming final exam, please focus on the theory as well. This is how we describe, and also calculations. Please refer to the lecture notes. That's one table to show you how to calculate the net cash flow. Very simple. Use biggest one minus the smallest one. The net one, it depends on outflow more or inflow more. Okay? Done this part? Okay, E. Differentiate between currency translation exposure and transaction exposure. This is about exposure. So possible, they're going to ask you to compare them by using definition. How many marks? Okay, how many marks? Let me see. Let me explain to you. 6 marks. So each have to provide 3 points at least. 3 comparison. So use definition and elaborate additional 2 points. So first, I show you the translation first. 3 points. Any 3 points you can get from the notes. So don't be lazy. Please go through the notes. Study how to explain translation. It's not give me keywords only. Remember, translation is when we actually convert all the financial statement item from foreign currency to home currency. Okay, and we are exposing to the risk because the currency fluctuation. Is the currency exposure when a company must convert the financial statement of its foreign operations from local currency to home currency. So the movement in ER here is stand for exchange rate. Write in full words, don't use short form. Movement in exchange rate between 2 reporting balance sheet period will change positively or negatively the value of the company financial statement. We have more elaboration in your notes. You can explain any 3 points. So similar for the transaction. You really got own take picture. Compare that. I just teach you, okay, based on the mark allocation, how many points you need to write. If only 4 marks, then each 2 points only. Okay, done? Okay, again, this one. So you just take picture for revisions. This is about moneyness again, and now they compare the in the money, out of money positions in call and put. So in this case, just now the question is asking call options only. Then explain 3, right? Look at the mark allocation here, 4 marks. So meaning that currency call option 4 marks, put option 4 marks. So you can explain like this: currency call options. In the money, out of money position. Do you need to explain at the money? No need. Okay, because question only asks about these 2 positions. So let's see how it explains. When spot price more than strike price. So this is good, right? Okay. So profit position if they exercise because option holder have the right to buy cheaper compared to the market. This answer same as just now, right? Okay. And these 2 marks only. So we explain another 2 marks when it is out of money. So 2, 2. Okay, 4 marks already. So for this case, do not exercise because what? Loss position. Currency put option will be everything opposite. Okay, go back, study this. Take this picture. Okay, done. Question 3, I only focus on C. Okay, 2 more questions. Bear with me. I know almost time's up. Okay, part C. Okay, this is about pegging system. Brunei dollar value is pegged or fixed to the Singapore dollar. Explain how Malaysia export to Brunei will be affected by the appreciation of the Singapore dollar against the Malaysian ringgit. Pegging system means that when Brunei dollar pegged with Singapore dollar, here is said that Singapore dollar appreciates against Malaysian ringgit. So what happened to the Brunei dollar? Also appreciates against Malaysia ringgit. Pegging system is like this. Singapore dollar appreciates, Brunei also appreciates against Malaysia ringgit. Clear? Okay, due to that, you have to answer what happened to the export. Now if Brunei dollar higher and then Malaysia ringgit relatively lower, right? Meaning that Malaysia product relatively cheaper. When cheap, right? Then the Brunei importer will buy more product or not? Yes. So export will increase. So how many marks? I didn't copy down the marks. Okay. So this is the answer. Should be 4 marks maximum. According to the point given here. So at the end, you need to mention what happened to the export. Why increase? Justify using these 3 points. Okay, last question for today, 4B. This one, I just want you to take picture, go back study, because all is about what? It's about factors impact on the MNC, okay, or we call it country risk. I just choose one to explain, the rest you read it your own. 8 marks. They say that discuss any 4, this is what I mentioned. Now they didn't give you specific like corruptions. You have to provide any 4 factor from the 9 factor that you study, okay? So you provide any 4, no need to provide additional one. I'm not going to mark extra, okay? Mark the first 4. So each will carry 2 marks. If you mention fiscal irresponsibility, 1 mark already, okay? And then you explain, okay? Explanation must be detailed. This part a little bit different because it already separate into 2 marks each. So I want you to explain at least how the fiscal irresponsibility impact on the country risk. That's why just now I stated on the whiteboard the format, definition, how it impact on the MNC and country risk. That one can apply to all kind of mark allocation one. So you don't bother about this one. Later on, you didn't give a sufficient answer, then you lost the marks. So you can give more elaboration, but not more factors. Factor limit to 4 only. Okay, please take the answer. Okay, now continue. I give you the rest. Okay, these are the other 2. Total got 9. You can refer to lecture note also actually. 3, 2, 1. Okay, am I too fast? Next, okay. Sorry, 5 and 6. Okay, next, 7, 8. Corruption just now you have taken, because actually I didn't go through the answer here, but I don't want to remind you, if let's say the question, the explanation here didn't mention about how it impact on MNC, means that not enough, because this is guideline for the lecturer only, for the marker. So you still need to explain how it impact on company MNC cash flow and the country risk. The last one. Okay, next week, I'm going to discuss another 2 sets paper, if possible. Then if you're able to finish on time, the last week, week 14, will be Q&A session. Means that the class is still on, but you can come and ask questions. Because our our exam is on week 15. So I don't think you have consultation time with me one. So that session may be Q&A. I will inform you next week. Okay? So please utilize the hours that we have. Okay, thank you. See you next week.